SPHD is the Invesco S&P 500 High Dividend Low Volatility ETF. It is designed to give you steady monthly income from stable companies while also reducing the ups and downs of the market. The goal is simple. Combine high dividend stocks with low volatility stocks from the S&P 500. But how does that work exactly? First, the ETF takes the 500 companies in the S&P 500 and filters for the 75 with the highest dividend yields. From that smaller pool, it selects the 50 stocks with the lowest price volatility over the past year. These 50 stocks make up the SPHD portfolio, so you are getting high income without taking on extreme risk. Every company inside the fund is already large enough to be in the S&P 500, but only the ones that pay high dividends and show lower price swings get selected. This gives the fund a unique tilt. Less tech stocks and more focus on defensive sectors like utilities, consumer staples, and real estate. Some of the top holdings include Altria, Kinder Morgan, AT&T, Iron Mountain, and Verizon. You will notice these are all known for paying strong dividends. The fund rebalances every 6 months to keep things fresh. It also maintains a limit where no sector can be more than 25% of the total weight. This protects you from being too concentrated in just one area like energy or utilities. Now let us talk about income. SPHD pays a dividend every single month. As of the most recent distributions in 2025, the average dividend is around $0.15 per share each month. That means if you held 1,000 shares, you would be getting roughly $150 per month in passive income. On an annual basis, the yield tends to hover between 4% and 5% depending on market conditions. That is much higher than the S&P 500's typical 1.5% to 2% yield. But it is important to understand the trade-off. SPHD prioritizes safety and income over massive growth. During bull markets where tech stocks are soaring, SPHD might underperform. But during downturns or recessions, it tends to hold up better due to its exposure to low volatility dividend payers. Over the past 5 years, SPHD has returned roughly 6% per year, including dividends. That is below the S&P 500 average, but with much less volatility. If you are a retiree or someone who wants reliable income without wild price swings, SPHD might be a great fit. Now let us talk about risk. Even though the fund focuses on low volatility stocks, it still carries market risk. If the whole market drops, SPHD will likely fall too, just not as much. Also, many of the stocks inside are in sectors like real estate and utilities, which are interest rate sensitive. When interest rates rise, these sectors often underperform, so keep that in mind. You are trading some growth for consistency. Expense ratio is 0.30%, which is reasonable but not the cheapest. That means for every $1,000 you invest, you pay $3 per year in management fees. The fund has over $3 billion in assets under management, which shows strong investor confidence. The average market cap of companies inside is mid to large cap. This is not a small cap or aggressive fund. It is built for stability. How does it compare to others? Compared to SCHD, which is another popular dividend ETF, SPHD has a higher yield but lower long-term performance. SCHD leans more into dividend growth while SPHD is more focused on high current income. Compared to JEPI or QILD, which use options for income, SPHD is simpler and more traditional. It does not use derivatives, just stock selection and rebalancing. In terms of volatility, SPHD typically has a beta of around 0.7. That means it moves about 70% as much as the S&P 500. Less movement equals lower risk, but also less upside. What is the best use case for SPHD? Monthly income. It is perfect for investors who want regular cash flow without chasing the riskiest assets. If you reinvest the dividends, it can also compound steadily over time. Not fast, but stable. For younger investors, it might serve as a solid core income piece alongside growth funds. For older investors, it can act as the backbone of a retirement portfolio. Now let us score it on my meter rating. Income gets a strong 8 out of 10. Monthly payouts and high yield make this one of the more reliable options. Risk gets a 7 out of 10. It is lower than average, but not immune to drawdowns. Volatility protection scores a solid 8 out of 10 thanks to its selection method. Growth gets a 4 out of 10. It is not built for capital gains. Simplicity and ease of use get a 9 out of 10. You just buy and hold. No options or rebalancing needed. My total score is 7.6 out of 10. SPHD is not flashy. It is not for people chasing big gains. But if you want a slow and steady ETF that pays you monthly and helps you sleep at night, this fund does the job. If you have any videos you would like me to cover, say it in the comments below, and I will break it down in plain English.